It is earnings season right now here in the middle of July. And one of our favorite stocks here on the channel just hit it big. A stock I actually just bought into, a stock that we've talked about a couple times, talking about Whitecap Resources. They just killed their earnings. There's some big news coming out. They've absolutely proven that this merger is a good idea. And I think they've proven for sure that they are undervalued. The people don't respect them enough. People don't actually see the vision here, but they're executing on it. I've got a couple things I want to show you today. I got some articles. I've got some press releases. I've got some slides from their earnings. Just so much information that I want to just go through a little bit with you. Talk about the important things, what you need to know for those of us that were at work instead of watching the earnings report earlier today. So right here on the screen, BNN Bloomberg. It's an article from the Canadian Press on here. Whitecap expects production to come in at high end of forecast range after Veren deal. This is the big idea. One of the things that happened when this deal happened with Veren is people were like, okay, well, sick. There was some question marks maybe about the incentives behind the deal. Why is it that one company was going to be 51%, one company was going to be 49%? You know, why was this management staying on? Why were Veren shareholders getting this? Et cetera, et cetera. But once the deal kind of came through, they're like, all right, well, now we got to see that this actually has the synergies promised. Because if not, then this deal was for nothing. Them coming in at the high end is huge for these skeptical investors. And by skeptical investors, I'm not talking you and I, normal people, normal money. I mean big money that all of a sudden just saw that there is a definitive shift in the production efficiency of this company, that they have very clearly not only hit their forecast, but exceeded it, or at least come into the high end of their forecast, right? They've exceeded the sort of median expectation, and they're likely to actually continue to do so. Let's go through what's in this article. Whitecap Resources Inc. says it's made good progress towards integrating the people and assets it acquired through its combination with Veren Inc. this spring. Seen plenty of early wins through the consolidation of corporate costs and improved credit profile, Chief Executive Grant Fagerheim told analysts on a conference call Thursday. By leveraging combined best practices and an enhanced scale, we are expecting to see capital efficiency improvements and operating cost reductions across the portfolio. The all-stock transaction with Veren closed in mid-May, made Whitecap the biggest landholder in the Montney and Duvernay shales in Alberta and BC, second largest oil producer in Saskatchewan. Through the second half of 2025, Whitecap plans to direct 3/4 of its capital budget on drilling in the Montney and Duvernay, with the rest in Saskatchewan and central Alberta. Whitecap says it expects production this year to come in at the high end of its forecast range of between 295 and 300,000 barrels of oil equivalent per day. Capital budget for 2025 remains unchanged. As we begin our 2026 budgeting process, our outstanding suite of assets provide us with significant optionality across the commodity spectrum, from light oil to condensate-rich natural gas to natural gas opportunities. Allows us to tailor our future capital program to commodity pricing and maximize our long-term value creation. Whitecap shares are up more than 5% in the afternoon trading on the TSX after it reported second quarter results. Net income at $310.6 million for the 3 months ending June 30th, up from $244 million in 2024, amounted to 33 cents per diluted share compared with 41. And like, considering the fact that they just basically doubled the size of the company, that's quite a diluted shares contract. It's really hard to sort of compare with last year. Petroleum and natural gas revenues were $1.37 billion, obviously a lot bigger, and they produced 292,754 barrels of oil equivalent per day during the period, compared to 177. Again, not quite, but just about a doubling. So some big things on there, big ideas. One, their efficiencies are coming through. Question mark with almost every acquisition. Does it actually make the business more efficient? The whole point of acquisitions or mergers or any sort of combination of businesses like this is to cut costs, because putting them together theoretically uses economies of scale to make it a cheaper business to run. And that inexpensive sort of business model allows for more return of capital, it allows for more expansion, it allows for the company to just be better. But the question mark's always there. Just because it theoretically allows for that doesn't mean it's going to happen. Here we're clearly saying, Whitecap saying, hey, look, this is happening now. The deal with Veren has made us, not will make us, not might make us, but has already, in a few months, we're talking since May here. This is not a long period of time. We're talking a couple of months here, has already had an impact. They're already seeing this happen. Really impressive. They're also talking about 2026 and leveraging commodity pricing. What does that look like? Well, probably looks like them taking advantage of the natural gas opportunity. Remember, they are a big Duvernay Montney shale basin player. This is the same basin providing most of the natural gas going to LNG Canada, same basin that is expected to see the other companies in there, the Tourmalines, the Arcs. They expect a huge amount of money coming to those companies as we see AECO prices of natural gas rising throughout the rest of this year into next year. So right here, Whitecap's basically saying, hey, us too. Look at that. We are also in this business. They also even mentioned things like condensates, which has been a huge part of ARC's business, giving them a little leg up. So they just are in a really good position. They expect the efficiencies to be there. They expect to be able to spend their money in a way that maximizes commodity pricing in the shorter term. There's also shale oil, which we talked about that in the United States being a problem because they're running out. But right now, the Montney and Duvernay is relatively, in relation to the United States, it's relatively untapped. There's huge potential there, and it benefits from being able to move quick. If we do see the natural gas prices we expect, you can expect Whitecap to be there making a huge amount of money off of those assets. Overall, looks really, really impressive for them. But that's not all. They also had a couple extra comments that they added during the conference call. On the screen beside me here, I've got this from Seeking Alpha. This is just their breakdown of the conference call because, again, lots of us are at work during the day, especially on a Thursday. We can't exactly sit down and listen to all of this. And you might be the kind of person that goes back and listens to them after the fact. I strongly recommend checking out fiscal.ai. They have a really fantastic feature for that. We will check out the earnings slides with them in a moment. But Seeking Alpha does a really good job breaking it down and sort of like writing out what happened. There's a couple of highlights here that I thought were really interesting. Production outperformance. Second quarter production is an increase of 5% per share compared to last year, 2% per share increase over the first quarter. Why do I like that metric better than what we just looked at on BNN? Because it's per share. Remember, this company basically just doubled. So trying to compare this year to last year is really a challenge. Comparing per share gives you sort of the easiest, best way to look at that, because the way the deal was structured means that the size of the companies sort of related to, I don't know why this is so difficult for me to say, the size of the company dictated how many shares each shareholder got. So Veren shareholders got a proportionate size as Whitecap shareholders have. So therefore, doing a per share basis makes it much, much more representative. So seeing a 5% increase over last year is nice. 2% per share increase over the first quarter of this year, also nice. Again, makes a lot more sense breaking it down per share. That's an asset level outperformance. So they didn't buy anything. They don't have new assets. They're just running them better. Funds flow, second quarter funds flow of $713 million, increased 6% per share compared to the second quarter last year. After capital investments, they had free funds flow of $304 million in the quarter. Their balance sheet looks really strong. Their quarter end net debt of $3.3 billion equates to net debt to annualized funds flow of 1.0 times. Unutilized debt capacity of $1.6 billion provides us significant financial flexibility to navigate through periods of market volatility. Very important to have access to that. Very important that they're in a position where they're not overloaded with debt. There was a time here in Canada where a lot of these companies were buying assets at whatever price or expanding at whatever price, racked up the debt, and we saw how that hit them when things went wrong. Nowadays, much, much more disciplined, and that's really, really good for us as shareholders. Finally here, return of capital. For the 6 months ended June 30th, we returned $298 million to shareholders through monthly dividend of 6 cents per share and share repurchases under their normal course issuer bid. Their normal course issuer bid was renewed in the second quarter, allowing for repurchase of 122.1 million shares, or 10% of our public float prior to May 22nd, 2026. So even since the video we made not that long ago, they are increasing their ability to repurchase shares. They're up to 10%. They were at about 8, maybe 8 and a bit percent last time. So they're continuing to repurchase shares. They're continuing to look towards that opportunity. They continue to believe the business is undervalued. The only reason they would spend so much money repurchasing shares is because they know that that is a good investment for us as shareholders. And if management thinks that, that's a really good sign for us, because they understand the business better than anyone. They see the nuts and bolts. They see everything that's working. Management at companies that don't actually believe in their long-term fundamentals don't repurchase shares. They just try to shove that money right out the door in a dividend, or they try to, be acquired by somebody better so that somebody else can deal with the challenges of running that business. This management team thinks that this business is still undervalued into the second quarter, not just the first, but now the second quarter of 2022 after the merger. Really, really interesting. I really, really do think that is a positive sign, and so does the market. Stock's up 5%. Now, I told you guys I would take you through the slides, and I absolutely will do that. Here on the screen, we've got fiscal.ai, formerly FinChat. Like I told you, really great resource if you want to go and sit down and listen to the earnings call yourself, if you're somebody who likes to do that. I personally, with all the time constraints, all the things demanding my time nowadays, I really do appreciate when I can look through like summaries or somebody else's analysis of it. But I also do really love to read through the slide deck, because that usually shows the best trinkets, the best, the bells and whistles that management's willing to show you. And I think this slide deck has some really cool things in it. So obviously they have a corporate overview. If you don't know the business, feel free to sort of pause here, take a look at what they say. Really interesting stuff. You can see exactly where the assets they own are. You see where their conventional low decline assets are in Saskatchewan. They also have their unconventional assets up in Alberta, right? You see all of the sort of important stats: the 2 billion maintenance capital, 3.3 billion net debt. That's a 1.0 net debt to funds flow. See their annualized funds flow, again, just about the same number. Their production currently, the enterprise value, the market cap, all those interesting stats. Q2 results, we got the same kind of things showing off here that they mentioned in the earnings call itself. We just read through. So that's that 5% per share growth in Q2. They also got their outperforming expectations. Like I said, they're at the high end of their guidance. At the high end, closer to 300,000. They might beat 300,000. We'll see how that goes. 298 million return to shareholders, right? Awesome share repurchases. We really love to see that. And net debt to fund flow is looking good. As we go down, prudent capital allocation with upside potential. They're showing their capital allocations, 25% to that conventional oil in Saskatchewan, 75% to the rest. See, their production is growing and growing and growing. Their forecasts are looking at 63% liquids. Their funds flow are looking really good. You see exactly what they're producing. They have their condensate business, the light medium oil business, NGLs, and of course gas. There's a big chunk of gas right now, which is actually really quite nice to see, especially with, again, that massive bullishness in the natural gas market coming from LNG Canada, coming from all these other LNG projects being built. Just the overall North American natural gas market is looking quite positive in the longer term. Generating significant free funds flow, of course, is awesome. Return of capital priorities we see here. Couple of really interesting things. We talked about their targets. They're going between 10 and 15% annually that they plan to return to shareholders. That's the growth. So they have growth capital that's added as return on capital employed increases. They got their base dividend and they got their share repurchases. I really like here that they emphasize how their share repurchases are going to help them enhance per share metrics and improve capital structure. And they're focusing on keeping that balance sheet strong. Really important at a time like this when we have all these question marks about the shorter term. I'm talking maybe 6 months to the next 2 years of global oil prices, where we've got these shorter term challenges. Following that, of course, we have the actual undersupply challenges that are going to have a whole different set of problems and solutions for them. But having a strong balance sheet is critical. We see their production as they compare to their peers, right? They're nicely in the 7th position as an oil and gas producer, 5th position as a natural gas producer. And so they may not be one of the natural gas companies, one of those firms that is very, very specifically focused on natural gas. They're not even a C&Q who's just got the scale that they can muscle their way in there as a massive natural gas producer. But they do produce a large amount of natural gas, a large amount of oil. They are in a big enough position now that they are a target, maybe not quite for acquisition, but for more institutional investment, more international investment. You could see them be more richly valued. They could make their way into more mutual funds. They can make their way as a bigger, not gigantic, but bigger chunk of things like ETFs, of various energy focused funds here in Canada. Even they could make their way onto the balance sheets of some like pension funds, things like that might have a minimum size that they're allowed to invest in, or minimum profitability metrics, or whatever it might be. Unconventional Montney allocation is really interesting to me. They have a 50% focus on condensate and liquids. They're focused on oil weighted and liquids rich natural gas. really interesting. They're talking about the various wells they've got drilling. They've got talking about the facilities they got going. Really interesting stuff. A little bit more Duvernay than Montney, but to be honest, for most retail investors, you can consider those as fairly similar things, fairly similar part of the world, fairly similar geology there from our perspective. But either way, really, really good stuff going on there. It really is quite impressive what they're doing so far. Their conventional capital allocation is mostly, again, we showed that map. They're mostly in Saskatchewan, though they do have some sort of in central Alberta. And you can see the difference there. We got 5.2 net wells. Basically, they built 10, but obviously 4.8 are coming down. In Alberta, 91 is Saskatchewan, so a considerable amount more in Saskatchewan. 80% of that's focused on oil and liquids. Their credit profile is looking really good. They show exactly where that is. They're also showing the maturity schedule, which is looking pretty good. 2029. One of the things that I think is really important for that, and that's for the main chunk of that debt. There's 195 million coming due in 2026, but considering the amount that they're free fund flowing, that's no big deal for them really. And the interest rate on that is not great, but it's also not terrible. I mean, interest rates right now are really a question mark, so who knows what it's going to be in a year. But the fact that they can wait until 2029 for this big chunk, this $950 million chunk, is actually huge, considering the fact that we've talked about a lot of the chop in the oil markets being sort of second half 25 through to maybe the start of 27, depending on exactly how bad it gets and how long this goes, and if the trade things happen or not, or whatnot, right? Followed by question marks about U.S. shale availability, question marks about global demand growth, question marks about all these different things that are going to have some short cycle impacts on the price of oil, where we expect the price of oil to be a little bit higher. I'm not thinking in the hundreds here, but significantly higher than it is in the 60s, making it a lot easier for them to pay down that debt, pay off that debt, refinance that debt, whatever it might be. They're going to be in a much better position by then, in my opinion. So they should be in a pretty good spot. Of course, they show their balance sheet management. They go through their net debt to funds flow. They show the WTI oil price, obviously very impactful, although not entirely correlated. They're showing their hedges here. They've got hedging for the rest of the year, somewhere in the 30s, let's say 41, 34. And then 2026, they're down to 22%. Natural gas production, again, is also hedged, with that number slowly decreasing, but staying around 30%, which is pretty nice. It's going to be quite impactful in the shorter term. I don't know what's going to happen in the longer term. Again, I'm a bull. I think that in the next 6 months, we should see the price of natural gas increase significantly for AECO producers, but we'll see. And of course, the corporate savings. You can see all sorts of optimizations and consolidations here. This was really what we wanted to see from this merger. Seeing it actually happen is huge. They're predicting more than 200 million in annual savings, which is just, again, fantastic. They also mentioned that they have additional infrastructure optimizations coming down the road here, significant opportunities to increase their margin, including streamlining operations, the asset duration and size that allows for preferential fees, access to third-party infrastructure, and they even mentioned things like strategic gas diversification strategies like LNG, data centers, and other opportunities. Again, that's something that we could see moving into the parts of the world where they're operating, right? That region of basically the Montney/Duvernay region could actually see data centers getting built there. There are some things that make it beneficial. There's obviously other things that make it less so. We haven't seen anything happen yet, but we've seen lots of big names talk about it lots. So maybe we'll see. This is where I'm going to pause right here. I want to take it just straight to the camera, and I want to talk to you guys about why this is important to me. I recently bought a little bit more Whitecap. I owned just a little bit in my sort of personal portfolio. I bought it in the large fund, which is my public portfolio. You can see it all the time on Blossom, and I have it on Snowball Analytics. It's publicly available. That's my Canadian dividend portfolio. I think this name fits really well in there for a couple key reasons, and I think that this earnings reinforced everything I was thinking. They are undervalued. People don't really understand that this name is there. Most investors probably know Canadian Natural. They probably know Suncor. Beyond that, you'd have to see an investor who's quite interested in the industry to really see somebody who can talk about a Whitecap, right? This is not a brand name stock in the grand scheme of things. Yeah, most of us on here know this stock. They know this company. We've talked about it a couple times on this channel. I'm sure you guys have talked about it before. Lots of people watching this own the stock. And so of course you know what this company is. But when we talk about big money, we're talking about not only Bay Street money, right? but we're talking about international money. And they need to see larger companies that are doing better, that are outperforming peers at a good valuation. I think Whitecap today proved that they're on that list. They proved that the merger was worth it, which is a huge question mark, sort of a weight around the neck of this business. Proving that the merger was worth it is huge for them. I also think that they proved that they're going to be able to outperform expectations. Even if they had just hit their target guidance, it would have been a fantastic earnings, but them outperforming is huge. And this is at a time, again, when, there's all these question marks about the price of oil. There's all these question marks about, is this industry really going to see the kind of investment that we've been promised from all these big infrastructure projects? Are we really going to see all this change? Well, to Whitecap, it doesn't matter because they are organically growing. They are able to outperform within the confines of their existing business. They don't even need to acquire more things. Their balance sheet looks strong. They look positioned for growth in the future. They're setting themselves up for success over the next 5-10 years. And that's exactly where I live investing in these companies. That's the kind of time frame I care about. And I honestly think that's where the opportunity is if you're investing in Canadian oil and gas. I think it's that 5 to 10 years where we see the real impact of the decline of US shale. We see the real impact of the increased growth of things like data centers and the increased reinvestment in industry here in the West. We see all of these trends play together, all this demand for energy just accumulate at a time when the US is no longer able to be the main supplier. Then companies exactly like this are going to benefit a massive amount. Why I bought the stock? I think a lot of people saw that story play out today. I think a lot of people are quite happy today. That's why the stock's up so much. And honestly, I think if you don't own the stock, you should seriously take a look and see if it has a spot in your portfolio. As always, I'm not saying you got to buy into this thing 100%. I'm not ever advocating for somebody to make a portfolio decision that looks like 100% one industry. But if you don't have any exposure to Canadian oil and gas, or even if you have minimal exposure, right, you're a 5-10% person, this seems like a pretty easy candidate to slot in there as another couple percent. That's just my opinion. As always here, if you like this video, please do like it. If you like what we do here on the channel, please do subscribe to the channel. And I hope I see you in our next video.